right. Hello and welcome to tonight's webinar, Using Your Personal Preferences to Find the Right Investment, presented by Charles Rotblut, creator of the PRISM Wealth-Building Process. My name is Jenna, Brashear, your host for this evening. We want to thank you all for attending and are excited to showcase identifying your investment management preferences of the PRISM Wealth-Building Process. And I do want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And if you have any questions for Charles or I tonight, please feel free to send them in via your GoToWebinar control panel on the right-hand side of your screen. And if you experience any issues with the audio or the video of the webinar tonight, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And a handout of the presentation is available under the handout section of your GoToWebinar control panel located on the right-hand side of the screen. And a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as any resources we discussed tonight. And for some of our new viewers, we'd like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And as I mentioned before, tonight's webinar is an interactive event. Therefore, we will be answering questions as well as polling the audience on various topics throughout the presentation. And so without further ado, sit back, relax, and enjoy tonight's presentation. Take it away, Charles.
Thanks, Jenna. Thanks, everybody, for joining us tonight. I will warn everybody, you might hear a snow plow in the background, either coming from my end or from Jenna's end. It's Chicago. It's winter. We have snow. But we're going to try to keep you all warm tonight, give you all hopefully some useful suggestions and education. And we're going to talk about our PRISM Wealth-Building Process tonight. Jenna will be joining us, and we'll also be having some polls, so it'll be a little bit interactive, and we're looking forward to tonight. So I guess enough with the introduction. I'll get started with the presentation. We're talking tonight about using your preferences to pick individual investments. And it's part of our PRISM Wealth-Building Process. And what PRISM is really a framework for aligning your investment decisions with your goals. The 5 steps of PRISM are really designed to help you create your own plan and to really empower you to make really good, smart decisions. And there's a lot of research showing that if you have a written plan, if you have a disciplined process for carrying out a task, and it can be any number of fields, but just merely having a plan and following it makes you more disciplined, reduces the role emotions play, and increase your odds of success. So we're giving you the framework to create your own plan, but I want to point out this is your personalized plan. We're just giving you the tools, the system to create your own plan, but ultimately it's your plan. You get to decide what goes into it. You get to decide what works best for you. And we expect everybody's PRISM wealth building plan is going to be a little different than everybody else's, and that's fine because this is supposed to be personalized. And there's 5 steps to the PRISM process. Step 1 is prioritizing your goals. And I want to point out there is a study, a well-cited study that shows that if all you do is just write down your goals, your odds of increasing them, your odds of success jump by 40% merely by writing down your goals. If you have a plan that you're sharing with people, your odds increase even more. But even just doing step 1 increases your odds of success. Step 2 is recognizing your risk tolerance and your allocation. Step 3 is identifying your investment management preferences, and that's what we're going to focus on today. You can see the green arrow on a flow chart. 4, selecting and managing your investments, and 5 is simply monitoring your allocation, your progress, and your life stages. And we're going to get into step 4 next month. Step 5 we'll get into the following month, and then we'll actually go back and revisit step 1 again. So this is an ongoing process, but I want to focus on step 3 today. And before I do want to point out something, and this is a slide I've used routinely in presentations throughout my career at AAII, and I think it's really important, and that's to realize that the optimal strategy, the best strategy in terms of investing, is never the one that maximizes returns. It's always the one you can stick with. And that's what PRISM is. It's really about identifying a plan that's right for you, that's right for your goals, right for your ability to withstand risk, right for the appropriate allocation, and right for the type of investor you are, how you want to invest, what you want to pick, what type of rules you want to use in terms of governing your investments. All that's part of the PRISM process. So the goal, like, as I said earlier, this is a really personalized plan, and find that optimal strategy is really a personalized process. What works well for one person may not work well for another. So again, we're giving you the framework, and we're going to go into some of the considerations into how your portfolio will be managed tonight. But I do want to beat this drum that ultimately this is a personalized process, and what you're really trying to do is find a plan that takes your goals and gives you the steps you need and the plan you need to achieve those goals. So why do we focus on preferences? Why do we make investment management preferences the third part of the PRISM process? And why do we stick it between identifying your allocation and selecting investments? Well, one of the things is that it helps you narrow down the choice of investments. So if you think about the world of investments, you can think about it in terms of this really large haystack. There's approximately 30,000 mutual funds, ETFs, and stocks. And I have not even gone to the thousands of bonds out there, and certainly the other investments you could potentially consider, a vast universe. And if you're clear about how your portfolio is going to be managed and who makes the decisions as far as which investments you hold, whether it's you, whether it's a fund manager, whether it's an investment professional, you've suddenly narrowed down that vast universe of investment choices and made it a lot smaller. And we all know that if you're looking for a needle, it's much easier to find a needle if you're looking at a small area of the farm rather than you're trying to go through the entire haystack trying to find it. But it also helps you write down and really solidify what you're going to do as an investor. What investments will you actually look at? Which will you not? And if you're clear about this, it actually makes it easier to listen to and really digest investment information. Because if you're one type of investor and you're saying, I'll only invest in these types of investments, and someone's talking about those types of investments, you now have the mental ability to tune those other investments out. It allows you to have a greater focus. But it also helps you become really clear about your constraints and what restrictions you face. And we'll get into those because you might envision yourself as one type of investor, but realize that, well, I'm investing in this vehicle and I really can't do X with it. I really need to consider Y. And if that's something you face and that's something you want to incorporate in your plan, and make sure you have a strategy for incorporating that in your broader investments. And I know it's a little bit vague there, but I'll get into that as we walk through the different type of investors, and you'll start to see how this plays out. And hopefully maybe it'll prompt some thoughts among yourselves about some restrictions or constraints that you have, but you really didn't necessarily think about because it's just part of what you're actually investing in. So before we do this, Jenna, I know we have a poll here that we want to actually have our attendees participate in.
Yeah, definitely. Let me get that situated. And I will launch that now, so feel free to participate. The first one is focused on how are your investments managed currently? So the options are, I pick what securities to buy and sell, I use mutual funds or ETFs, I handpick stocks and use mutual funds, ETFs, or I work with an advisor. So feel free, I'll keep it up on the screen. And
Yeah,
once we,
yeah. Go ahead, Jenna.
oh no, go ahead, Charles.
No, I was going to say, as people are taking these polls, I just want to point out to members that we do an annual member survey, and we do find a wide variety among our members in terms of how they actually invest. Whether they use security, whether they pick individual stocks, whether they use funds, mutual funds or ETFs, whether they work for an advisor. We do see a variety across the board. So I'll be curious to see the people who are attending tonight. I'm curious to see what how you all have your investments managed.
Definitely. And it looks like people are just wrapping up. Give you a couple more seconds on voting. Looks like 77% has voted so far. So thank you again for participating.
Great.
Yeah. Right, I'm going to close it right now. And I will share the results. Excellent. So it looks like that most people handpick stocks and use mutual funds and ETFs, kind of a combination of both. And then the second, about 27%, is that they just pick individual securities to buy and sell. Interesting.
Okay. Interesting. Interesting. Well, great. Well, thanks everyone. We'll have another poll later in the survey, but love seeing that love seeing the feedback.
Thank you. Yeah.
So we're going to talk now about, we're going to actually go into identifying your management preferences and in our PRISM wealth building process, and we'll show you a little bit later where you can find this. But we have worksheets along the way, and these are really designed to help you build your own PRISM wealth building plan. And so for step 3, identifying your investment management preferences, we actually have a worksheet where we ask you various questions to try to help you define what type of investor you are. And I want to point out that we don't actually say that if you hit, click on this box and you click on this box, this means you're this. We actually give you some guidelines because there are shades of gray. And in creating this, we settled on 7 types of investors. We really try to think from an investment management viewpoint, how would we describe different investors? And it's a bit challenging because often people do fall and have their foot say more than one bucket, and there may not necessarily be just one type of investor. So in this worksheet, when you fill it out, you'll notice at the bottom, we give you some guidelines and we say this type of investor is XYZ, this type of investor is ABC, to help you decide what type of investor you are, because you might find yourself really being a combination of one or the other. And we'll go through these tonight, but there are 7 types of investors we settled on: a fully hands-on investor, a partially hands-on, an index investor, a fund investor, a combo hands-on, works with an advisor, a bolt-on, and an advisor. And I'll walk through all of these so you can understand what each of these names mean, and hopefully help you better visualize where you might actually fit among the scale. So the first one's it's a fully hands-on investor. This is the type of person that loves to roll up their sleeves and really digs into it. Yeah, I myself, I'm a tinkerer. I love seeing what's going on, kind of getting my hands dirty, researching, and really a full hands-on investor. We view it as someone who picks their own securities. They pick their own stocks. If they're investing in bonds, they pick their own bonds. They want to have full control over the individual securities that go into their portfolio. And these type of investors, they have the interest in doing it. They have the knowledge to do it, but they also have the time to actually do that as well. And the nice thing about being a fully hands-on investor is it gives you full control. You make all the decisions. And certainly if your goal is to perhaps outperform the market, this is one of the ways you can do it. You have as an individual investor, you have full access to the range of publicly traded securities. So you're not just limited to the S&P 500 or say the Russell 2000. You can go up and down in terms of market capitalization. You can invest in stocks that trade with much less volume than a lot of professionals can invest in. So there are a lot of advantages to being a fully hands-on investor. Obviously, the big risk is behavioral errors. You might picture yourself as being a very good stock picker, but you might pick bad investments. So there is that risk to doing this. But we do know that individual investors following disciplined processes, investing based on research that's shown what has worked in the past, can be successful in terms of fully managing their own portfolios. Now, there are constraints to being a fully hands-on investor. You might really want to do this, but there might be things that might stop you. One of the things is where you're investing. So perhaps your workplace retirement plan, or perhaps you're saving for a child's or grandchild's college savings. You might have to invest through a plan where there is no brokerage window, where you are having to invest in mutual funds. Like 401ks, 529 plans are good examples of this. Another thing is if you have a health savings account, depending on your health savings account, you might be restricted in what you can invest in those. So again, when I talked about constraints earlier, these are examples. If you're investing in bonds, depending on how much you're allocating to bonds, depending on how willing you are to look at bond prospectuses, that might make it more difficult to invest in individual bonds. If you want to hold foreign securities in your portfolio, you do obviously have the choice of investing in ADRs or American Depository shares in the US, but a lot of stocks aren't necessarily listed, so you may need to invest on foreign exchanges, and that might be something that's difficult for you to do, or it might be more costly for you to do. You also have an issue when you're dealing with foreign securities. What information is being provided is different. The accounting standards might be different, and so that might be a difficulty for you, or a difficult hurdle if you want to do that. But you also, I would say, consider your time and consider your interest. You might really love digging into financial statements. Then again, the thought of you even opening a 10K filing on the SEC's website, and a 10K filing is the annual filing companies are required to file with the SEC. You might find those things to be the most boring thing you've ever read. If that's the case and you don't really enjoy the research, that's totally fine, but just be aware of it and recognize that's a constraint that you have, that, you know what, at the end of the day, I don't enjoy this research, and there's nothing wrong with that. If you do and you have the time, great, by all means do it. But just be honest with yourself, the type of investor you are. And there, again, there's no wrong or right. Don't try to put yourself into a type of profile that's not you. Find the one that works best for you. And I'll bang on this drum a little bit throughout tonight, because it comes down to what type of investor are you and what's your preference. Now, what you could do, however, is be a partially hands-on investor. So maybe there's certain aspects about active investing that you like, or maybe there's certain aspects you can do and certain aspects you can't. So again, going back to a really simple example, you're working full time, you love picking stocks, you spend your time researching stocks, but you have that 401k plan at work, and that forces you to hold on to mutual funds. And so when we look at a partially hands-on investor, we view it as someone who does select their own securities, but they also use funds. And perhaps it's not using a workplace retirement plan. Perhaps you realize, you know what, I want to pick stocks, but I'm going to use funds to get allocation to bonds, or I'm going to use funds to get allocations to foreign investments. Or perhaps you're picking stocks, but you want some allocations to real estate, so you're using a real estate investment fund. Those types of things. So it's really a blend where you're handpicking some securities, but you're also perhaps using mutual funds, ETFs, or even closed-end funds for others. And so it's more of a mix. And so when we say partially hands-on, you're doing some stuff yourself, but then you're also using funds for other aspects of your portfolio. So in our Prism Academy, we've been discussing about choosing between funds and individual securities based on preferences. Jenna, do you want to comment on this real quick?
Yes, definitely. So lesson 4, which premiered last week on last Thursday, we talked about choosing between funds and individual securities based on your investment management preferences. So things that we already talked about were, constraints or types of accounts. Those are things that you needed to take into account before deciding if funds or individual securities might be best for you. So in the Prism Academy, I do prompt everybody who hasn't been able to log in yet and go through lessons 1 through 5 now. Lesson 5 debuted this afternoon. But lesson 4 focused on, and we asked our Prism Academy members, does your portfolio comprise mostly of funds or securities, and why did you go to this route initially? And then the second one being, which constraints that you identified in the last lesson and how did they impact your decision to focus primarily on funds versus individual securities or vice versa? So we do prompt our members to go in, log into the Academy online. You can visit it at community.aaii.com and yeah, share your response and see what other members have talked about in there.
Great, thanks, Jenna. Yeah, definitely. Please join us in community. So now we're going to start going into funds. One of the things is you could be an index investor, and obviously Jack Bogle is the late Jack Bogle was obviously the poster child for this. But index investors, as the name implies, they seek out index funds, tracking broad-based, well-known indexes. Your Barclays bond aggregate, your S&P 500, perhaps your Russell 2000. They love getting that low cost. They love the simplicity of a pure index fund. And index funds are a great default investment because you'll get the market's returns. And index investors tend to love having that low cost. They love the fact that they can get diversified exposure with really just a handful of funds. Really, honestly, if you wanted to build a very simple diversified portfolio, get a total market ETF or mutual fund, combine it with a broad-based bond fund, and you're done. So it can be very simple as that. And one of the advantages about being an index investor is that it requires very minimal effort. Set your allocation, find the funds that look right for you, check them maybe once a year to make sure that nothing's materially changed in terms of the fund, and that's it. So there is that simplicity, there is that low cost aspect about being an index fund investor. Now, you may want to only limit yourself to index funds, but again, you might have a 401k plan. You might have a 529 plan. Maybe your health savings plan does not include index funds. You have to consider actively managed funds. So that might keep you from fully being an index fund investor. You may also want to think about perhaps tailoring your portfolio. And a good example are bond ladders. So you know you're going to have a goal that's going to require spending, say, in 5 years. Maybe you want to ladder bonds, or perhaps in the current interest rate environment, perhaps you want to use CDs instead. That would cause you to veer from being more index approach, more passive approach, to doing something more active. Now, do realize that if your goal is to beat the markets, you're never going to do that with index funds. By design, index funds are going to give you the market return less a very low expense ratio for those funds. They're not designed to beat the market. Now, you can beat a lot of investors through index funds by simply being more disciplined than them, but you're never actually going to get returns higher than a broad-based index, say like the S&P 500 or the Russell 2000. And again, being an index investor does not mean you can be completely hands-off. You still need to monitor your allocation and make sure your allocation not only stays in target, but evolves as your life evolves. Now, you could, of course, be a fund investor, meaning that you're looking at actively managed funds. And I will point out Annie Prada, when she was helping us pick out stock photos for today's presentation, she wrote to me and she said, I don't know exactly what a fund investor looks like. And I said, just be creative. And so she came up with this vending machine photo. And I will point out, if you think about a fund investor, it actually ties into it because you're really looking for this package solution. You're looking for a fund that gives you exposure to a certain category or a certain asset class. So it is actually pretty apropos, and it's actually good symbolism. But with a mutual fund investor, we're envisioning this as being an active investor. So to go back, on the index side, we're envisioning this really being this dyed-in-the-wool, Vanguard-like investor who really wants to get low-cost index investing. Fund investors want to take advantage of active management. Now, they could also incorporate index funds. So perhaps they wanted to do index on some aspects and active on other aspects. So it can be a combo. But the big difference, again, is this use of active management. And the idea of having active management is that there are some active fund managers that outperform. And there's some pockets of the investing world where it's less efficient and where there might be an argument for considering active managers. Obviously, the big challenge in selecting an active manager is determining which active manager is going to outperform in the future based on past information. It's a high hurdle. It's not easy to do, but we do know there are some active managers that have outperformed in the past. Now, whether they'll continue to do so in the future, that's a whole different discussion, and certainly not one that we can have in the constraints of tonight's presentation. But when you are using actively managed funds, you do want to consider the higher cost. You do want to consider turnover. You want to consider the tax cost ratio, and you can find the tax cost ratio by simply typing in a mutual fund name or ETF's name or ticker into the search bar on AAII.com. You will find our ETF and our mutual fund evaluator that'll have that information. And the less tax efficient a mutual fund is, the more you need to consider where you place it in terms of a taxable account or an IRA, a tax sheltered account. But there is this risk of underperformance once you start figuring in all the costs and perhaps the tax ratio as well. So Jenna, let's pause for a poll here before we move on about asking investors about whether or not they get some help with their portfolio management.
Go. And I'll go ahead and launch. So feel free to put in your votes. But so basically, like Charles said, the question is, do you use a professional to help you with your finances? So you can select only for taxes and or estate planning, so specific tasks or issues. Or I periodically consult with a planner. I work with a financial advisor, or I do everything myself, so self-reliant. Let's go ahead and take some time to vote.
And Jenna, instead of me humming the Jeopardy tune, any questions that come through?
Nothing yet, but I do want to remind people to submit their questions. We had a few people with A+ Investor that are joining us, so thank you again for attending tonight's event.
Absolutely. Thank you.
Looks like about 76% has voted, so go ahead and get your votes in before I close. And just a quick call out too, inside the Prism Academy online, we actually do weekly polls, so you can always participate there. And we do include those polls and links to the polls in our weekly emails that I send out on Saturday morning at 10 a.m. Central. So you can always look forward to that if you want to share your responses or your ideas or how you're interacting with the lessons. They kind of usually coincide with whatever lesson is that week. So if you want to go in there and check those out, we update those weekly. All right, I'm going to close the poll now and I will share the results. So it looks like about 34% they use professional help with taxes, estate planning, other specific tasks, and about 38% are self-reliant, so they do everything themselves.
Interesting. So we know, just for everyone's information, we actually do a member survey where we survey a random group of members, and we know about 30% of members overall do work with a planner or advisor. So we do have a broad mix, and obviously with a broad AI membership, it is a mix, and we're going to actually talk about that. But obviously, we encourage investors to do what works best for them. And so one of the things we came up with is this idea of a combo hands-on work with an advisor. So the idea here is that you're doing some things yourself, but you're also consulting with someone. A good example of this is that you're picking most of your investments, but you're meeting with a planner once a year to just say, hey, how am I doing? How's my progress? Are things working right? Or perhaps you want someone you can actually consult with, call when you're nervous. Or perhaps you're splitting your portfolio where you're overseeing part of your portfolio and you have an advisor overseeing part of your portfolio. And I would say if you're in that situation where you're managing some of your investments yourself and you have an advisor overseeing some of your portfolio, make sure you have that conversation with your advisor about what you're doing. It'll help the advisor better make decisions for you. And I saw a survey several years ago, and I can't remember the exact percentage, but it was pretty high about how many people don't tell their advisor what they're doing themselves. And I think it's important to have that communication two ways. Obviously, if you're working with a robo-advisor, depending on a robo-advisor is not always someone to speak to, but at least when you're filling out whatever questionnaire they give you, you want to take that into mind. But the idea here generally in this situation is that you are, like I said before, having your feet in these two buckets where you are managing some of the stuff yourself, but you're also working with an advisor. And if this is who you are, just work into your plan and consider that into your investing decisions and what you're going to pick, what you don't, or what you're not going to pick. And one of the things you'll notice on the slide, I had to mention a robo-advisor. So if you're using a robo-advisor, and these are basically computerized advisors, they'll tend to actually have they'll tend to have some type of more of a off-the-rack type allocation. And if you're using those, you may want to consider, well, what do they have me in? And then what don't they have me in? So perhaps they have you in more of a market type portfolio tracking broader known indexes. And perhaps then you might want to use your own investment selections, perhaps tilt yourself. Perhaps you favor value, perhaps you favor yield, or perhaps you're more of an active trader. You like momentum. So think about maybe doing things that you're not necessarily doing. One mix I've seen over the years is that people work with an advisor, have their portfolio pretty conservatively managed, but then the part they manage themselves, they're very active and they're very aggressive with it. So again, there's no black and white when you fall into this category, but just understand what you're doing, what you're using an advisor for or the planner for, and then understand what they're not doing for you and incorporate it into your portfolio. So if they're having you do certain things that's more, say, quote unquote, mainstream or more market-like, then perhaps with the investments you're managing yourself, maybe that's where you consider going off some tilts or maybe after some specific strategies to complement it. Now, there's also a bolt-on approach, and so we view this a little different. So when we looked at a combo hands-on works with an advisor, we really thought about someone who's working with an advisor or planner to do more high-level overviews or perhaps more manage their actual portfolio. The bolt-on approach is we really look for someone who's working for a specialist. So you manage your portfolio, but perhaps you need someone to assist you with tax issues. Perhaps life insurance is part of your estate planning process. So you want to consult with an agent. Taxes. I know several of you said you work with an estate attorney or a tax professional. Perhaps this is a case where you're hiring someone to specifically help out with your taxes. Or perhaps if estate planning is a big issue for you, perhaps you're working with an estate attorney, and perhaps part of that discussion with the estate attorney, you're looking at your IRAs, or perhaps you have trust set up and how that plays into a role. So this is a case where you might be either a fund investor, you might be an index investor, or you might be a do-it-yourself, but you're hiring a professional for certain aspects of your portfolio. In that case, just be clear about who you're hiring and what you're hiring them for. As a quick aside, when you're doing this, think about who you're using, write it down, and then communicate to your heirs and communicate to the people you'd want to step in on your behalf. At least have this contact list somewhere where they can find it. If they need to step in, something unfortunate happens to you, they at least know who you're supposed to talk to, and perhaps at some point, at least maybe perhaps do a phone introduction, particularly with someone important like your state attorney, where if one of your heirs needs to call up, at least the attorney knows who they are, and there's been that previous conversation with them to make things go smoother. Now, there are constraints you can have when you think about this. And again, if you're a dyed-in-the-wool do-it-yourself investor, realize there still might be things you need assistance on. Again, estate planning. You might feel comfortable if you have a very simple estate creating your own wills, but you start getting to things like trust, perhaps your own estate's more complex. You might want to need an estate attorney. And every professional you hire, do you realize it does add complexity to the process? It may simplify certain tasks for you, but you're also adding something into the mix. So you want to make sure you incorporate it. And again, being clear about who you're hiring, what you're hiring them for, and how that affects your overall wealth building process. But I also encourage you, in terms of hiring someone, make sure they're the right person for you. So um, make sure you know exactly what you want, what type of communication you want, what type of professional you want. Um, a little extra research early on makes a difference. And finally, you may have the constraint about not knowing what questions to ask. In the journal, past issues, we've talked about questions you can ask advisors. We've talked about what types of professional certifications you need to look out for. So we do have some of those in the journal that you can find. But that is a constraint that if you need help, you at least need to know what type of help you need and also know what types of questions you should ask. Now, the final type of investor is an advisor investor. And we view this as someone who hands over control of their portfolio to an advisor, be it a human advisor or a robo-advisor. And this works well for someone who just doesn't have the time or doesn't really have the interest to pick their investments, or perhaps maybe you're new to investments and you don't have, you don't feel like you have the knowledge quite yet. You can also consider this, though, if you're getting older, because we do know as investors progress through the retirement years, the risk of cognitive decline sets in. And we're talking things like cognitive impairment, Alzheimer's, dementia. And one of the first signs of cognitive impairment is just simply the inability to manage your own finances. It's a very big risk. It's a very real risk. And at a certain point, at a certain age, you might realize that, you know what, I need to have a professional take over my finances. I don't feel comfortable making decisions myself. And an advisor can make sense here. Now, do realize this is the most expensive approach, particularly if you are using a human advisor. You can use robo-advisors. They are cheaper, but not as cheap as if you're a true long-term buy and hold investor or you're a pure index fund investor. That's still the cheapest way. Now, there are considerations when using an advisor. Again, you can see on a slide, I mentioned this issue of cognitive decline. But if you're working with an advisor, make sure you research an advisor, particularly the human advisor. Go to broker check, type in their name, see if there's been any complaints against them. Contact your state securities office and see if they have any complaints on an advisor on file. I would also just do an online search, perhaps go to Google, type in the advisor's name and see what comes up. Most of the time you may not find anything, and what you find, nothing bad. Maybe you find out that your advisor perhaps has spent the last year really perfecting their sourdough recipes. That's totally fine. But if you start seeing things that make you a little queasy, make you kind of question things, that's a red flag, and that might be a sign that you may want to consider finding somebody else. But also, when you talk to an advisor, have a conversation with them about their process. What's their preferences for investing? How aggressive are they? How conservative are they? What type of communication do they provide? If you get nervous and you need to talk to someone, are you going to be able to reach them directly? Are they going to have you speak to one of their assistants? Um, do they want to meet with you quarterly? Do you want to meet with you semi-annually? Are they comfortable perhaps with just annual checkups? All these things, and they sound like soft skills, soft items, but every investor is different and every advisor is different. So you want to find an advisor that's a good fit for you. And you might find an advisor that perhaps your friends or your relatives swear by. She's a great advisor. And you might find out the way they run the practice is not right for you. That's totally fine. You want to find the right fit for you. Now, I do get asked occasionally, can I recommend an advisor? I cannot. What I always tell people is, ask friends, ask colleagues, ask people you trust who they use. You can also go to sites. There's other sites such as the National Association of Fee-Only Planners. I'm drawing a blank on the actual acronym right now. But I'll give you my email address, charles@aai.com. We'll find it. I'll have Jenna add it to the Prism to community as well. There are sites you can look at. The CFP website as well will help you find a certified financial planner. So there are places you can go look for an advisor, but it's also like a doctor. Find people you trust and ask them who they use and who they might recommend. Now, we're giving you a lot about the types of investors, about preferences. And so obviously the question is, you might be asking yourself, what do I do with all this information? So what we would say here is think about what type of investor you are, where you fit into it, and then think about the implications. So if you're a fully hands-on investor, that means solely focus on stocks and bonds. If someone's talking about ETFs and mutual funds, you know what? Close your ears. Tune it out. It doesn't mean anything to you. If you're really a purely hands-on investor and all you want to use is stocks and perhaps bonds, if that fits into your allocation, then tune out everything else. Just focus on the stuff that's going to help you be a good investor. And say you're a stock investor and you're a dyed-in-the-wool value investor, then tune out the stuff about growth stocks. Don't look at stock screens that focus on growth investing. Just focus on that value category, for instance. And obviously, if you're growth than value, that switches. Or if you're momentum or technical analysis, again, use that to narrow down your investing process. So when it gets to step 4, selecting your investments, think about those preferences. What type of investor are you, and what are you looking for? If you're an index investor, then you can really tune out pretty much everything, because your goal is to be a long-term investor and you really want to be on guard for stuff that's going to sway you from being an index investor. So take back, if you want to watch CNBC every day because you find it interesting, great. But realize when people are giving recommendations, you only really want to keep your ears open when they're talking about index funds. And really, has there been a change in an index fund that you're using? You want to be very conscious if there's been a change in the index being followed and what the implications are for your investments. Fund investors, then you're focusing on the best funds for you. You're not really worried about, this particular stock. You're not really worried about what's Tesla going to do tomorrow. Your goal is really to find the best funds. And when you're a fund investor, your goal is not only to find the best funds, but to stick with them. Data from Morningstar, data from Dalbar shows that the average fund investor underperforms the very fund they invest in. Why? Because they try to time. And the whole idea of having a fund investor is that you're handing your money over to a professional and you're letting them run the process, and you're going to stick with that fund over an extended period of time. And obviously you want to monitor the fund quarterly, semi-annually, annually to make sure the fund's doing what it's supposed to be doing, that there has been a broad change. And obviously, if over a period of years, that fund is underperforming its category peers, that would warrant a change. But when you go into a fund, you should be going in with a longer term focus. And it applies to whether or not you're looking at mutual funds or ETFs. And then finally, if you're some type of a combo investor, maybe a bolt-on, maybe you're working partially with an advisor, be willing to let go of what you've handed over. Be very clear about that line. I'm having the advisor manage this, or I'm having the professional help me out with this. Let go of that responsibility and just focus on the things that the advisor isn't doing. That, as an investor, if you hand it off some of your portfolio to an advisor, and again, they're managing it more in terms of a broad market standpoint, let that stuff go and start thinking about, okay, what should I do that the advisor's not doing? And again, it might be some type of tilt towards small cap, perhaps momentum, perhaps yield, or perhaps you want to take a more active approach, such as trading more frequently. Whatever it is, make that your focus. So I mentioned earlier, use this analogy as having this huge pile of hay, you're trying to find that needle. What I'm saying here now is work through step 3, identifying your investment management preferences. And then here you can see here how you're narrowing it down. So this whole idea is, if you're clear about your preferences about what you're going to invest in, and then perhaps you incorporate some style considerations, all of a sudden when you get to the next step about selecting your investments, you have a much narrower focus about what you're looking at. And so that's why we stuck this between allocation and selecting investments, is that think about how are you going to actually look at investments. And once you narrow it down, I think you'll find this really empowering and really simplifying your investment process. So following one thing, I know when we talk about preferences, people want to know about taxes. And I've given this a lot of thought because the PRISM process does not directly address taxes, but I think it really comes to that next step when it comes to selecting your investments. What types of investments are you going to hold? But also, if asset location comes into play, then you might be able to put in your rules. I'm going to look at this investment and this investment because I know it's less tax efficient. It's going to go into this type of portfolio. So I think it really comes in to step 4. And step 4, selecting your investments, we're going to get into your buy and sell rules. And I think you incorporate it into that scenario. So Jenna, I know we have the worksheet available to help people identify their preferences. Do you want to explain to people where they can find them?
Yeah, definitely. So if you log into the online AAII Prism Academy, there is so that is the community.aaii.com. There will be a library tab that you can go into. Those are actually all of our worksheets are in there for all of the lessons that we currently have. And we're also going to be uploading worksheets for even the future lessons. So you can go ahead, get a start, look at it, fill those out, and you can download those to your computer as well, so you can have copies of them at any time. So it'll be under the library tab, and also on the AAII.com website, you can go to a planning page, which is on our top navigation bar, and it'll say Learn and Plan. And under the PRISM Wealth-Building Process toolbox, which will be on the right-hand side of your screen, you can actually go in there and download all the worksheets as well. And then we also have our complete resource guide in there as well. So you can take a look at articles that we have about the PRISM wealth-building process, as well as all of the corresponding worksheets for P, R, I, S, and M. So you can go in there at your leisure, at your convenience, and download that to your computer. So
Absolutely.
And as far
Go
as
ahead.
applying what you learned, I was going to explain a little bit about this. So in the PRISM Academy community, we asked members a couple different questions. So each lesson corresponds with varied questions that we have. So one of them, starting with, is how certain criteria and constraints, like the ones Charles mentioned, such as time, education, wealth, interest, may affect their investment management preferences. How the type of account that you currently have, or that you might have in the next 5 or 10 years, how that may impact how your portfolio should be managed. And the last one is how the differences between funds versus individual securities may also impact who manages your portfolio and assets. So participating in the online community helps you get more value of the PRISM Academy as a whole. And yeah, there's lots of great discussion topics. We have members, commenting, sharing what what works for them, what kind of constraints they've had to consider through this process. So it's honestly very eye-opening, and I've learned a lot of different perspectives from just reading all of everybody's responses. So feel free to jump in there and anytime you want, and yeah, we'll look forward to it.
And I'll jump into our next step. We'll do this actually in March, I guess. Trying to get our journal out today, so I'm a little mixed up my months. But we're going to get into step 4 next month about selecting and managing your investments. So each month we're rolling out a new webinar discussing the different steps. And I know, Jenna, we're also covering these in community as well in our PRISM Academy.
Yes, exactly. Awesome. And as just another reminder, go ahead, and so you can join us in the PRISM Academy to complete step 3, which is identifying your investment management preferences. And basically, there's the worksheet, the preferences worksheet that is in there. We talked, there's in the library tab, and then also on the AAII.com website. And yeah, it's simple, it's easy to get into, and you can join hundreds of members who have already joined the PRISM Academy online. And just a few things, if you haven't had a chance to go into the online academy, I just wanted to give you a little bit of background because we have a few new members who maybe haven't had the time to get in there yet, but it is an interactive experience to help you create your own personalized wealth building plan with Prism. So the Prism process is cyclical, like Charles said. So we go from P, prioritizing your investment goals, R, recognizing your risk tolerance and allocation, I, identifying your investment management preferences, S, which is selecting and managing your investments, and M, monitoring your allocation progress and life stages. So it takes you through the whole process, and then basically whenever there needs to be a change, you go into a new life stage, anything you wanted to get into a different allocation strategy or want to diversify your portfolio, then you can start from P again and go down and see if maybe you need to prioritize new goals because you've reached retirement or something like that. So you can use it time and time again, which is excellent, especially going through, like I said, different life stages throughout your life. And in the Prism Academy, there's instructional videos and tools. So we kind of rotate between articles that are related, video lessons that Charles has created, as well as flow charts and diagrams and other tools to help break down the Prism process. And then there's in the customizable worksheets, like I said, there's one for each lesson, and you can find those in the online community. And of course, there's the community forums, so you can share ideas, new perspectives, discuss Prism with other AAII members. It's a great way to connect with people across the nation who are in the same situation as you, who are asking the same questions. And so we definitely want to encourage all of our members to try it out and see what they like, and also give us our your feedback. We love hearing what you think about the Prism Academy. If you'd like to see anything that we haven't covered, you can feel free to message me or Charles in there at any time. So yeah. And these are just some links.
Go ahead, Jenna.
Oh yeah, these are just some links, just so you have them. You can also check out on the handout section on the right side of your screen, and then we'll also distribute the handouts afterwards, so those links will be in there as well. And just a reminder, if you didn't go into the AAII Prism Academy online today, so step 3, lesson 5, we just debuted earlier this afternoon to all Prism Academy students, and it is focused on how to decide whether you may need a financial professional to assist with managing your portfolio or not. And ways that you can interact with lesson 5 is that you can read the prompt, you can check out the infographic, you can participate and respond to the 2 questions in the prompt, and read other members' comments. And then I don't know if you want to share a little bit about the Prism Academy schedule, Charles, or?
Yeah, absolutely. So like I said, we've been doing this, we've been rolling out the Prism Academy gradually on here. So you can see here, so this month we've been rolling out step 3, identifying your preferences. On March, we're going to address how to select your investments, and I'll be doing a webinar as well. And then step 5, we'll be doing monitoring allocation, progress, and life stages. And I will point out, we will actually late spring, early summer, we will swing back to step 1, prioritizing your goals. And so Prism is an ongoing process. So this is not, I went through the process, I created my plan, I'm done. This is actually a living document, the Prism wealth building process. Your wealth building plan is actually something that's going to evolve as you do. So when we get to step 5, you see where it says progress and allocation. So as things change and your goals change, we expect you to continue using this. So this is a lifelong process. Even though we're showing 5 steps, the idea is you keep using these 5 steps to stay disciplined and to have your plan evolve as you do. This, again, is supposed to be a living document that you can use, talk with your family about. If you work with an advisor, talk with your advisor about, and update as your needs, your goals, your life situation changes, hopefully for the better. And now, I guess, do we have any questions?
Yeah, we have one from Bill. It was actually a fantastic question. He said that I think a lot about portfolio allocation and invest only in funds so far. And he would enjoy investing in individual stocks to try to beat the market, but it seems like a very time-consuming task. Do you have any advice on how to be a partially hands-on investor without that becoming a full-time job?
Yeah, absolutely. One of the things you could do is just if you hold a lot of funds, you're getting a lot of diversification. So because of that diversification, you could actually hold fewer stocks than if you were completely allocating the stocks. So what you could do is if there's a few companies you're interested in, you could perhaps just invest in those with a smaller portion of your portfolio while keeping the majority of your portfolio allocated to funds. I would also point out that you really can look at stocks less frequently than you may realize. For our model shadow stock portfolio, we only do a review on that quarterly. For our stock superstars report or dividend investing portfolio, we only make decisions about making portfolio changes once a month. The average investor holding an individual stock, they could probably check it once a week to see if there's been any material change in the stock's fundamentals, see if there's been any news. They could even, but for a long-term investor, they could actually go even less frequently. So even though it sounds like with all the investment media and all the chatter, like you have to constantly watch what your stocks are doing on a daily basis, the reality of the matter is unless you're really using a purely trading type strategy, you really don't need to look as frequently. But you do need to do your research, and if you really want to dig in, you're more of a long-term fundamental investor, that will require time. But realize you could go into it slowly, picking one stock at a time as you have time to do it. So it doesn't have to necessarily be a time-consuming process. There is some investment of time, some investment of willingness to do research, but you can set your own parameters. And as I said, if you hold a lot of funds, you could get away with only holding fewer stocks because most of your portfolio already gives you that diversification.
And let's see, we have one talking about retirements. We touched that on that earlier in the presentation. So if this is from Mary, if someone is approaching retirement in the next 5 years, like I am, and I have a lot of time on my hands, no other constraints that I can think of, would you still think about index funds like you mentioned, or is that too safe enough of an option?
It really comes down to your personal preference and how comfortable you are selecting your own securities. It really isn't a question that one's better than the other. It really comes down to really a lot. Honestly, people always say it comes down to skill, but a lot of it just comes down to discipline. Being able to have a disciplined process for picking investments that's been based on what's worked in the past. And if you have that discipline, you have that interest, you certainly can pick individual stocks, but it really comes down to your ability to follow a disciplined process for doing that. And then just your own personal preference. There really is not a right or wrong. For some people, they love index investing. It's a right fit for them. Other people love being do-it-yourself investors, and they do really well at it. So um, it really just comes down to your preference. And you certainly could blend the two together where you do have index investments and you are also handpicking investments as well. I actually fall into that category. We talk about constraints. Our 403B plan here at AAII is managed through Vanguard. So I automatically have index funds through there. My wife's IRA is put into index ETFs. My IRA, particularly with my Roth IRA, I'm investing every paycheck. I'm putting a little money in there, so small amounts. A large part of that's held in ETF. So I actually do this combination of index investing, but also holding individual stocks. But again, it's more of a personal preference and who you are as an individual investor yourself.
Makes sense. And another question by John. If you invest in stocks only, what is the number of stocks you consider to be an optimum size portfolio? So a little bit off topic, but also, just talking about how to diversify properly.
Yeah, that's a great question. And I did hear Charlie Munger, the co-chairman of Berkshire Hathaway, yesterday. They showed on CNBC, and I think he said that you didn't need more than 4 stocks. And my answer to that was, if you're Charlie Munger and Warren Buffett, you probably can get away with just 4 stocks because their investing IQ is several standard deviations. There's several degrees well beyond average. Um, as an individual investor, we use for our portfolios, we usually recommend people for stock superstars or dividend investing or shadow stock or VMQ. We usually suggest people have between 10 to 15 stocks. Uh, there is a lot of debate about what the magic number is, but a good way to think about it is if you hold 10 stocks and one stock goes completely zero, say one of the stocks is Enron, and all of a sudden in a matter of 6 weeks, or it's Lehman Brothers, in a period of days, it goes from having a pretty large market capitalization down to zero, and that stocks, and you'll hold 10 stocks, then only 10% of your portfolio is encountered a complete loss. And the more stocks you have, the more you're diversifying against idiosyncratic risk. So idiosyncratic risk is really the risk related to one single investment. And the market does not compensate you for risk you fail to diversify. So if you want a number, I would say probably above 10. Probably when you start as an individual investor, when you start getting above 20, 25, that's probably a level where you probably get more complexity than benefit. But I'd say you're between 10 and 20, and you really pick some very diversified stocks, and you're really careful about diversifying across industries. And unless you're purposely tilting towards small cap, say small cap value, different categories, you can get away with a fairly probably somewhere around 10 in the team diversification.
And we got actually quite a few questions in, so thank you for sending them in. Let's see, we got okay, let's see. Oop, down. As far as costs and fees associated with financial professional financial planners or advisors, why should I care about the costs involved in investments if net of fees a fund consistently outperforms their peers?
No, that's a great question. I've heard this before. The danger is when you have a fund that's charging, we'll just use an example, say a fund's charging 1%, and then you have an index fund that's charging 0.1%. So that fund, every year, that actively managed fund has to has earned almost a full percentage points, really 0.9 percentage points. Every year it has to outperform the index fund just to give you the same return. And then to beat the index fund, it has to do better than that. So even if the index fund has done, an actively managed fund has done in the past, realize it still faces that hurdle going forward. Now, maybe the fund manager possesses some certain talent. Maybe the fund manager is finding a certain part of the market that he or she is able to exploit, is able to do so. If so, that's great, but realize it's a question of odds. And we do know that over time, there's a lot of turnover in which active fund managers outperform. And we do know over time, a lot of active fund managers tend to outperform the index funds. So it's a question of odds. It's a question of, can you find that small group of active managers that have been in the index funds in the past and are able to do so in the future? So not impossible, but not easy either. So that's a thing you have to realize, and why we concern about expense ratios is that active fund manager still going to be able to get over that hurdle on a long-term basis in the future as well? If you found someone you believe that can, and they actually do, great. But just realize it is a matter of overcoming higher odds and tougher odds.
And in regards to different kinds of accounts, especially retirement accounts, we have a question by Richard. Does the Prism Academy cover IRAs and conversions of traditional to Roth IRAs, especially after someone who has retired, and vis-a-vis keeping investments in taxable accounts?
It does not. We're really focusing on the broad investment process and the decisions you need to make. That's more of a tactical decision, which we don't get into too much in the PRISM process. I have talked about internally in the office about creating an addendum to it for considerations like that, because we know there's certain things that are considerations. In the first iteration of the PRISM process, for instance, I actually had estate planning documents in terms of keeping tracks of your accounts and who you work with, and a sheet. And we probably will make some of those available as an addendum. And certainly the idea of a Roth conversion, whether or not to do that, it's certainly something I could consider making as an addendum. We did actually run a pretty good article a few months ago by Roger Young at T. Rowe Price, kind of thinking the pros and cons of doing a Roth IRA conversion, and we certainly can get that link to in the show notes if that'll help you make a decision about whether or not a Roth IRA conversion is a right decision for you.
And a similar, kind of similar question about taxable accounts. But somebody, so Jim had a personal question. So I recently moved a taxable account from Ameriprise where it was managed by an advisor. It is in all active mutual funds, and the account now has a huge unrealized capital gain, over 200,000. That's causing me a huge tax problem. Is there a way to handle this without creating large capital gains taxes? By the way, he just recently retired.
Yeah, that's a tough one if you're in that situation. If you have losses, you can put against those funds. That it helps a lot. But if you don't have losses, um, unless one of the funds has a bad year, but you're probably still going to have large gains. Um, Unfortunately, the really probably only way to do this is to consider dollar cost averaging. The other thing you could consider too is look at your tax situation. If there's years perhaps where you're making big charitable donations, and obviously I hope this doesn't happen to you, but perhaps you have large medical deductions or you have other deductions on your taxes that you might be able to offset those capital gains. You certainly could consider using that. Unfortunately, otherwise your only other choice is to perhaps just realize those capital gains over a period of time to try and avoid having one really bad tax year. I'm sure you're not the only person that has that situation, and it's a tough one. And unless you have something to offset your gains beyond just trying to dollar cost average, so to speak, those capital gains, meaning realizing them over a period of years, there aren't really good options for you. And I hate saying that, but I'd rather give you a truthful answer than one that's incorrect.
Yeah, no, I would definitely appreciate that. And we actually just got another question from Stephen. So most of the discussion that we had tonight was, on equities. Yeah, for someone at or approaching retirement, the fixed asset portion is, pretty large and very important. Recently, this has not been a great place for returns. Do you offer any suggestions?
It's really tough to have that bond allocation, and I read actually about Mark Tishman talk about rebalancing having that bond allocation. Um, it gets into selecting your investments, and the purpose, even in this current interest rate environment, um, bonds play a role by dampening the volatility of your portfolio. And we'll get to selecting your investments in step 4. So it really comes to the question of what do you actually hold for this? And you have options. You could think about whether or not you just want to hold intermediate term bonds. Do you want to build a bond ladder where you're actually holding individual bonds that are maturing certain dates? You could consider also whether or not you want to use CDs instead of bonds. So if the interest rate market changes, it might be easier to get out of the CD. There are defined maturity bond funds, which mature like bonds, so you can buy those set to mature at different dates. This we're going to cover more in step 4 a little bit in terms of what you actually select. And that's really where it plays into a role of, okay, my allocation says I should have this allocation to safer assets, and I'm going to manage this safer assets myself, or I'm going to actually use funds to do it. Then we get to step 4, selecting your investments. That's when we start getting at considerations about, okay, how do I go about filling that? And I'll give some broad guidelines for selecting it. But answer your question is you do need to get a little bit creative and think about your options, but also realize that even in the current rate environment, the whole role of having safe assets such as bonds is to really dampen the volatility of your portfolio to a level that you can't handle the volatility of stocks from a psychological standpoint, but also from an investing standpoint. And I will point out in the March issue, I did an interview with Wade Fowle, and we did talk about sequence risk, which is a risk as you're transitioning to retirement, the stock market incurs a period of really bad returns, what that means for your allocation. and what are some of the considerations you need to have in terms of balancing that out. So I know really it's a little bit of a long-winded answer, but again, this idea of which bonds you use, that really falls into step 4 of the PRISM process, which we will cover next month.
And sequence risk, also we cover in the step 2, recognizing your risk tolerance and allocation. So we have video
Absolutely.
lessons. I know you delve into that and everything, so that's great. And the last question we have actually is, you did mention earlier in the presentation about shadow stocks. Is there a shadow stock ETF that you can get into?
You know, we get that question actually. I've got a question several times over the year. The short answer is no, there's not. And the reason why is a shadow stock portfolio, because we'll consider stocks as small with market capitalizations as low as $30 million. So we're going really small, and most mutual funds and ETFs simply can't go that low because they have too much money to invest. So the whole notion of shadow stocks is that Jim Clunan, our founder, when he was looking for stocks, he envisioned looking for stocks and basically in the shadows of Wall Street where there's less competition and more mispricing. There are mutual funds, there are ETFs that do give smaller in size. And so you want to look at your small cap ETFs, look at your small cap mutual funds, and look for funds that really try to go small. They won't go as small as shadow stock, but you could get there. I think Larry Swedroe during our conference last year mentioned, I think he mentioned Bridgeway having a very small cap ETF. I haven't looked at it. I can't comment on it, but I can tell you, you can go, if you click on Journal on our website, you'll see guides. I'll take you to our mutual fund guide or ETF guide, or better yet, just go to our February Journal. We have our ETF guide, our mutual fund guide there. Look in either of those for the small cap value category for either mutual funds or ETFs, and then start looking at those funds individually and looking at what market cap size they look at. And you really want to look for funds that are going for deep value and as small as possible. Again, they won't go as small as a shadow stock portfolio will, but at least will get you in a similar type of field of stocks, similar type of category of stocks.
Excellent, excellent. Yeah, I think that's all of our questions for right now. I appreciate everybody for sending them in. We love answering anything that you can throw at us.
Yeah, absolutely. Yeah, thank you for answering your questions. And again, you can find us on community. You can reach out to me directly, charles@aai.com, if you have individual questions. But I want to get some final comments here. What I said earlier, the PRISM Wealth-Building Process, this is a living document. And so we're having you create this plan, not to just go through the process of creating the plan, but to actually give you a plan you can use for the rest of your life. And again, if you have family, talk about with your family. It gives you a good opportunity to start that conversation about who you are for investor, why you're investing, what's important to you, and perhaps it'll lead to a conversation where you're able to pass along your knowledge to them as well. And PRISM, the goal here is to provide a framework. We're not telling you specifically how to invest. We're giving you the structure to create your own plan that governs investment decisions for yourself. So as I said earlier, the PRISM Wealth-Building Process is designed to be very personal, and your own PRISM plan may be very different than somebody else's, and that's great. We want it to be tailored to your own goals and to your own needs. And if you have multiple goals, consider going through steps 2, 3, and 4 separately. Going through the idea of identifying your allocation, your risk tolerance, identifying your investment management processes, selecting your own investments. Consider doing for each different goals, because each different goal might require a different allocation, might have you investing in a different type of account with different constraints, and might require different types of investments. So again, PRISM can be a single document with several branches to it. And Jenna, I know we have an upcoming webinar next week.
Yes, we do. So on February 23rd, we have the Individual Investor Show, Improve Your Allocation by Gauging Risk and Ranking Asset Returns. So we'll be talking about 2 articles in the February issue of the AAII Journal. It'll be it'll be different asset classes. We'll look at the asset class heat map, And then we'll also talk about the risk-adjusted returns and the Sharpe ratio as well. So that'll be really good. It'll premiere at 7:30 p.m. Central, and you can register for this webinar as well as any upcoming webinars that we have by visiting aaii.com/webinars.
Great. Thanks, Jenna.
Yeah.
And thanks everybody for joining us.
Yeah, thank you so much for joining us. I wanted to thank you, Charles, again for delving into how to identify your investment management preferences. And I'm sure everyone is really excited to log into the online Prism Academy to participate in lessons 1 through 5.
Great.
Yeah, and I also wanted to mention again that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as any resources that we discussed. And before we wrap up our presentation, I wanted to announce I wanted to thank our sponsor, Discover Bank, with a quick video. So Charles, do you have any last remarks?
Just I want to thank everybody for joining us on this wintry night here in Chicago. And like I said, take advantage of Prism. We've created this for you, and I think you'll find it'll help you become a more disciplined investor. And I think also it'll not only help you reach your goals, but I think it'll give you some additional clarity as well. But thank you for joining us tonight.
Yes, thank you so much.
And now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit aaii.discoverbank.com to learn more.
And with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and take care.